Okay, Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. I am Dr. Adli. Today I would like to cover on the chapter 17 um, from the Muamalat Integration of Akli and Nakli. So in chapter 17, what we are going to talk about is about financing. Okay, financing your business. How do you want to actually finance your business? Now, our learning objective today is actually looking at the debt financing, equity financing, securities, other method, composition, remedies, and also we will also look at the Islamic financing. All right, the type of Islamic financing that we can actually use in assisting our business to expand, whether it's for a new business or whether it's we want to expand your business and so on. All right, so the key decision in business, in running a business, basically, um, um, this is actually being taken from another book. Okay, so basically, we want to look at what type of debt financing that should we use to obtain funds, and number two is what type of equity financing should we use to obtain funds. Then should we issue securities to obtain funds? Okay, should we actually issue stocks, or should I use leasing, okay, to finance the business and investment in facilities? And then what would be the best mixture of debt and equity, okay, that we can use to finance our business? And also, what are the remedies available to my business if it is unable to repay its debt? So basically, that is one of the risks in doing business. Sometimes our business does not go well. So what we have to do is when that thing happens. All right, now let's look at the debt financing first. Now, when we talk about debt financing, so there'll be the interest element here. This is based on conventional, we call it debt. But if you use the Islamic financing, then interest element cannot be in the picture. So instead of interest, because interest is prohibited in Islam, so there will be alternative to interest. So many of the Islamic banks or Islamic issuers are using sales and purchase contract, leasing contract, and so on. So basically, they change it, okay, from interest to profit, okay, or rental, or fees, and so on. All right. Now, also, there's another issue that we have to know is the capital that we want to get. Okay. All right. So the amount of loans that we want to borrow, and also collateral. What would be the collateral? What would be the mortgage that we want to what you call it, to secure the loan? Okay, for example, if you go to the bank, and then if you just want to get a free financing from the bank, which is unsecured loans, normally the bank will not give you the loan, because if you are just in the new in the business and so on. So that's why you need to provide collateral, so that their risk of non-repayment can be reduced to a very minimum level. And then also you need to know what would be the loan rate. Okay, what would be the percentage? Okay, maybe it's 2% or 3%, or maybe it's 4%, 5%, and then it goes up until 10%. Okay, for any available financing that we get from the banks, or from any other institutions. So these are basically, when we talk about debt financing, there's the element of interest, there is element of the capital or the loan that you required, and then the collateral, and then the rate that we are going to pay, all right, to the bank. So basically, normally we will as a business, we will try to find the lowest, okay, loan rate, or the lowest interest that you have to pay to the bank, because when the interest is high or the rate is high, then we will reduce, okay, our net income will be reduced. Okay, the earning after tax will be reduced because the interest is high. So that's why we need to do some window shopping so that we can get the best financing rate in what call it, running our business. Then we also need to know uh, the differences between fixed versus floating rate. What is fixed rate and what is floating rate? Normally, fixed rate is actually the interest rate that you will be charged is fixed in until the end of your maturity. Okay, for example, if you borrow some funds from the bank and then the maturity is 5 years, then the rate will be fixed, okay, until year 5 at interest 1. All right. Now there is also another thing where we call it the floating rate. So floating rate is actually depending on the rate of the cost of fund of the bank. For example, if in Malaysia we have the base lending rate, or for the Islamic is this the Islamic financing rate. So basically, the bank will offer you, for example, uh, BFR or BLR plus 1%. So if the BFR or BLR is 2%, then you have to plus 1, then you get 3%. And then this rate will actually varies from time to time as the BFR or the BLR actually move up and down. So if the in the period of a rising interest rate or a rising base financing rate, so you can see that your the interest will be becoming higher. But in the case of the we call it declining interest rate, then you can see that your interest will be lower, then you will have a cheaper interest that you will be paying to the bank. So this is one of the major differences between fixed versus the floating rate. So the conventional banks have it, and the Islamic bank also have this floating rate that you can actually ask them if you want to have a floating rate as compared to the fixed rate. All right, now the type of loans that we will discuss today is actually we have this ongoing operation. So basically, ongoing operation is actually basically your business must be ongoing, right? And then we have the term loan and also the line of credit. So the term loan basically is a long-term loan, and then the line of credit is actually the line of, the amount of financing that have been given to you in terms of such as overdraft and plus with all other financing facilities like bankers acceptance and so on. So these are the type of loans. So we have what you call it the long-term loan. This is term loan, and also we have the short-term loan. So the short-term loan is actually basically the loans that are given within a short period of time, for example, from 1 year to 5 years. Then we have the term loan, which is more than 5 years, more than 5 to 10 years, and maybe to 20 years. Okay, all right. Now there is another we call it financing alternative compared to loans from the bank. We can actually issue bonds. Actually we are trying to get funds, and then we issue our bond to the public. Okay, so the public or to the institutional investors. So what would be the difference between bond and also loans? Loans we get it from the banks, while bonds we get from the public and also from the we call it institution. Okay, so basically bond is actually the same as what we call it loan, except it is long term in nature, and also what we call it the bond is actually is what you call it is a long-term loan that we have to pay, for example, coupon, the interest, they call it coupon interest, right? So basically the coupon interest can be paid either 6 month, or which is semi-annually, or quarterly, which is in 3 months basis. So basically the bondholders, the person who buy the bond, okay, from from the company actually will receive the coupon interest. Okay, this is for the bonds for conventional. But if we use the Islamic bonds, then interest cannot be taken into consideration again. So instead of using interest, there are also other contracts such as using the rental. Okay, so instead of receiving interest, you'll be receiving rental from the company. All right. So we will not discuss about the differences between the conventional bond and also the Islamic bond. But here, I have to explain to you, okay, what would be the characteristic of the bonds here. So basically, indenture is actually the outline, okay, about what would be determined in the bond. Um, and a secured bond is actually bonds that have collateral, okay, with because it's actually a long-term note. Okay, so basically the investors need to see what would be the collateral of the bond. Okay, so that then if you are secured, then you will have like a rating. Okay, rating, for example, this is assigned by a certain agency. This is Moody's and this is Standard and Poor. So the higher the rating, okay, the lower the risk and higher the confidence of the investor to invest in your company. And the lower the rating, for example here C and D, and then you can see that the investor might be having a lack of confidence, but the rate, okay, that they have maybe would be higher, okay, because we are looking at the high risk, and then we have to charge also a high return. And then there are also unsecured bonds. Unsecured bonds are not being backed up by any collateral, so it is on clean basis. And then also we have the protective covenants. Okay, protective covenants is are the, what I call it, the guidelines or the protection that are being specified in the bond, so that, for example, okay, the bond money, that the proceed from the bond, okay, the funds, okay, cannot be used to, for example, to venture into unspecified business, okay, rather than what has been specified in the bond. That is actually a protective covenant to make sure that the funds, okay, the investors money are being protected. Okay, so this is what I call it, the protective covenants. And then commercial paper, this is another type of short-term what I call it, financing. Commercial paper is short-term, normally it's $1 million in multiples, and then the interest rate, there is there also charge interest rate. So basically, people who are holding commercial paper will receive interest um, from the investment. And then we also have another type of financing. We call it common creditors. Okay, common creditors are the commercial banks, saving institution, finance companies, pension fund, insurance companies, and so on. These are the common creditors that we can actually go and acquire funding from this organization, and in return, probably they will charge interest or profit, okay, based on the contract that are being laid out, okay, for us. Now let's look at the second one, okay. So we have the debt financing. The other one would be the equity financing, because you can actually raise money, okay, for your company by using these two types of financing. The first is debt financing. The second one is equity financing, right? So for equity financing, what we want to actually look at is are the retained earning. You can actually increase your equity by actually increasing your retained earning, and also you can actually issue stocks. Okay, normally stocks are actually the amount of capital that has been contributed, that are contributed by the owners of the company. So if your company is a Sanjaran Berhad, or what I call it, private limited companies, then the shareholders are the owners of the company. Normally the shareholders are between 10 to 50 people. But if you are a public listed company or a Berhad company, then the owners of the company are the people who invest, okay, or buy the shares or the stocks, okay, of your company from the initial public offering or from the secondary market in the stock market. So in the equity financing, something that you like to know is that the dividend policy. So how much money that the company want to provide to the investors in terms of dividend. Basically, investors who buy stocks from a company, they actually expect return, and these return are divided into two. The first return is capital gain, whereby if your company or the stock the stock is listed in the stock market, okay, the price gain, okay, from the increase of the price is actually called capital gain. But there is another return, which is the dividend that you receive after holding the stock for a certain period of time. Normally you hold the stock for 1 year, and then you will receive dividend for 1 year. And here the dividend policy is very important for your company. For example, if you believe that, okay, for example, if your earning after tax, okay, the net income after tax is 100 million, okay, that is your earning after tax, and you believe that the next year you will need about 50 million in terms of running the business, of paying your expenses and so on, the salary and so on. So here you need to actually provide about 50 million of the earning to finance your next year operation, right? And then you have another 50 million extra, and that 50 million you can give as dividend to your what call it investors. Or if in the case that, for example, if your net income is 100 million, but your expenses is probably from let's say 100 million also, then if you want to pay 50 million in terms of what we call it dividend, then you have to find alternative of how you want to raise 50 million in order to pay dividend for your investors. All right. And then stocks. We look at stock. For example, we have three different type of stock. Okay, this is a common what we call it in the market. The first one is common stock, or the ordinary shares, if we call it in the American language. So common stock are normally the what we call it the stock that being offered, okay, in the stock market. And then we have also preferred stock. Now preferred stock is actually almost the same as common stock, but it is also similar to a bond because it pays a fixed dividend. So it is actually a hybrid between stock and bond. So preferred stock has a, I call it a priority in terms of liquidation, and also in terms of what I call it liquidation. Okay, basically, if the company is being liquidated, so the preferred stock has a higher preference to be paid before the common stockholders. And also, but however, the preferred stockholders do not have the voting right as compared to common stockholders. Common stockholders has the voting right for in any annual AGM, for example. And then we also have venture capital. Venture capital normally they will there are the angel investors. They will pump in money for the company to become big, and then and then after they have make money, then they will actually what call it withdraw their position from the company. All right. And the public firm. Okay, we look at the public firm here. We have three different, we call it three different issues here. The IPO. So IPO is actually stands for initial public offering. So initial public offering is the first time that the stock is being offered to the public, right? And then we have also stock mutual fund. Okay, stock mutual fund is actually what we call it unit trust. In Malaysia, we call it unit trust. So basically, it's actually a company is being formed, and then fund is being collected from the public, and then that money, that we call it fund, is being used to buy certain stocks in the market, in the stock market or in the bond market, and so on. And then also we have the secondary market. The secondary market are the stock which are being listed in the Bursa Malaysia. So we can buy the what you call it, the stock, okay, from Bursa Malaysia. So Bursa Malaysia is the secondary market. Okay, now let's look at the differences between debt versus the equity. So basically, if you look at debt, okay, the credit, this is for debt, okay. Creditors such as commercial banks, savings institution, and finance company give loans to the company, and then the company have to pay interest payment and also the principal payment. So you have to pay interest and also the principal. And if you look at here, this is creditors such as pension fund, insurance companies, and bond mutual fund. Now this is actually for bonds, okay. So this is loans, this is bond. So the creditors purchase the firm bonds, and then the firm actually have to pay coupon and also principal payment. So instead of paying interest, they call it coupon, but it's actually the same as interest. And the third one is actually investors. Investors such as pension fund, insurance companies, stock mutual funds, and also individual investors, they purchase the firm stock, and then the firm stock will pay dividend to the investors. All right. And then some of the firms, we call it income, will be kept at the we call it retained earning. So this retained earning actually can actually increase the price of the stock of the investors. Okay, that is the differences between loan. Okay, this is loan is debt, then bond, and also this is we call it equity or the stocks. Issuing equities, okay, basically we look at the first is actually look at the origination. Okay, basically origination is whereby the investment bank will actually evaluate the company and then advise the company on how much is the stock that they have to issue, so that there will not be what you call it over issue or under issued. So over issue is actually basically that you issue your stock more than what the investors demand. All right, so if that happened, then the price of the stock will go down. And under issue is actually basically whereby your stock is actually uh, lower than the demand from the investors. So this is no problem, because when it happen, then the stock price will go up. And then the underwriting process is actually basically the investment bank will try to guarantee that you will get, okay, the guaranteed price of the stock, right? They will get the guaranteed price of the stock, even the price of the stock goes down, right? So you will be guaranteed on the underwriting. So that is the underwriting. And then the distribution part is actually being done whereby you have to get approval from the Securities Commission first to issue the stock, and then after you get the approval from the securities, we call it from the Securities Commission, then only you can distribute your prospectus to the potential investors. All right, so that is for the issuing of stocks. There is also another, what I call it, method of getting financing. All right, so the what I call it, this is actually normally being used by companies, and this we call it the supplier financing. This is actually a free what call it of interest, okay, free of interest financing. So you get financing from your suppliers indirectly when you get credit from them. For example, supplier financing, for example, firm receive supplies from supplier on March 1st. Okay, we buy from the supplier on March 1st, but we do not pay any single cent here. So what we do, we will only pay to the firm, to the creditors, to the suppliers on the August 1st. So in 1, 2, 3, 4, 5 months, we have free financing from our supplier. Now, if we compare with no supplier financing, so when we receive supplies from the supplier, we have to pay to the supplier, and instead of getting free financing from them, so we have to borrow, okay, money from the bank. So here on the August 1st, then only we firm sell product and pays off its debts to the lender, which is to the bank. So we here we incur what we call it cost or interest cost to the bank. And compared to this one, when we got supplier financing, we are actually being financed by our supplier, and this is without any cost, but sometimes the supplier will include the cost of finance in their selling price. And there is another type of financing is actually using leasing. Leasing is actually you only rent, okay, lease the asset from your lessor. So basically, you still have full control of the assets. However, you do not actually purchase the asset. So you only use the asset as a lease, right? You still have full control, and there is also lease period and also the lease payment that you have to pay to the lessor. So what we do here is that it actually can make it the company more flexible. For example, if it's actually leasing a factory, so if the company want to move from that factory, so if the factory is being leased, then they can actually certainly they can actually find a new factory, because leasing is actually you don't actually purchase the asset, you don't actually purchase the factory, you only lease the factory at a certain period of time. As compared, if you have already purchased the asset because you want to have a bigger factory, then you have to sell the factory first, then only you have to buy another factory, the bigger factory. Okay, now let's look at the capital structure between debt versus equity. So which one do you want to choose? You want to go for debt or you want to go for equity financing? So there are trade-off between these two. So if you have too much debt, then it will be riskier for the company. If you have too much equity, the cost of fund is much more costly for you, because the cost of issuing stock are actually much more expensive as compared to get the cost of getting financing from loans and also from issuing bonds. And let's look at the remedies for that. So we have formal remedies and also we have informal remedies. Informal remedies, normally we will actually discuss. This is in the case of you are having problem with your debt. Okay? You cannot pay your debt to your lender. So first, informal remedies is actually you try to get some extension, okay, by discussing to extend your credit period, okay. And then you might also want to do a composition, or what you call it when I was working with a bank, we call it haircut, okay. So we like to actually negotiate with the creditors whether they can give a haircut. For example, if your borrowing is 100, then you give a haircut of 0. Maybe 40, and then that 60% as a waiver, okay, to relieve you from the debt. And also, if you cannot do the informal, there is another one, which is the informal liquidation. The private liquidation is actually you will liquidate your business and then pay your creditors. All right, and if you cannot, if you don't want to do that, you can do like a formal remedies. The formal remedies is either you go for reorganization or restructuring. So normally when we do restructuring, we will look at what would be the best, okay, the best solution in especially for the creditors. The creditor will actually evaluate if they want to go for reorganization or they want to go for bankruptcy. Because if the cost of reorganization, they will get lesser benefit as compared to go for bankruptcy, then definitely they will go for bankruptcy. All right. So with that, we will finish first for this first part of the video on financing. We will continue on the second part of financing, which is using the Islamic financing. Thank you so much. Okay. Um, Assalamualaikum warahmatullahi wabarakatuh.